You pay rent on time every month for 5 years. Never miss a deadline. Never damage anything. You follow every rule in a lease you barely understand. And at the end of those 5 years, you own exactly nothing. Meanwhile, your landlord now owns a property worth $40,000 more than when you moved in. And you helped pay for it. This isn't a conspiracy, it's just math. But the math has started to break in ways that weren't supposed to happen. Let me show you what I mean. In 2012, the average rent for a one-bedroom apartment in the United States was just under $900 a month. Today, that same apartment costs around $1,400. That's a 55% increase in 12 years. Your salary, statistically, did not go up 55%. But here's the part that doesn't get talked about enough. Rent isn't just rising. It's rising faster than wages, faster than inflation, and in some cities, faster than the cost of buying a home outright, which creates a strange paradox. Renting is becoming so expensive that people can't afford to save for a down payment. And because they can't save for a down payment, they stay renters. And because they stay renters, they keep paying higher rent. It's a loop. Let's start with the basics. Renting used to be a neutral financial decision. You'd rent when you were young, mobile, or uncertain about where you wanted to live. You'd buy when you were ready to settle down. The system wasn't designed to trap anyone. It was designed to offer flexibility. But something shifted after 2008. When the housing market collapsed during the financial crisis, millions of people lost their homes to foreclosure. Those homes didn't just disappear, they got bought. And a lot of them got bought by investors. Not families, not individuals. Investment firms. Between 2011 and 2014, private equity companies and hedge funds spent tens of billions of dollars buying up foreclosed single-family homes across the country. They turned them into rental properties. Entire neighborhoods that used to be owner-occupied became renter-occupied. And those renters weren't renting from a local landlord who lived down the street. They were renting from a corporation headquartered in another state. This was new. This was a structural change in how housing worked in America. By 2020, institutional investors owned more than 300,000 single-family rental homes. Companies like Invitation Homes, American Homes for Rent, and Progress Residential became some of the largest landlords in the country. And they didn't operate like traditional landlords. They used algorithms to set rent prices. They raised rents annually based on market data, not on whether the tenant could afford it. They bought homes in bulk, which gave them pricing power in local markets. And because they were managing thousands of properties at once, they could operate with a level of efficiency and ruthlessness that a small-time landlord never could. Here's what that looks like on the ground. Let's say you live in Phoenix. In 2011, a 3-bedroom house in a decent neighborhood might have sold for $120,000 during the post-crisis fire sale. An investment firm buys it. They rent it out for $1,200 a month. Over the next decade, they raise the rent every year. By 2023, that same house rents for $2,200 a month. The tenant in that house has now paid the investor roughly $250,000 in rent over 12 years. The house itself is worth about $400,000. The tenant owns nothing. The investor owns an asset that tripled in value. And the tenant helped pay the mortgage, the property taxes, the maintenance, and the profit margin. That's the trap. But it gets more complicated. Because even if you wanted to stop renting and buy a home, the system has made that harder too. The down payment on a house used to be the main barrier to homeownership. Save up 10 or 20%, get a mortgage, and you're in. But now, even if you have the down payment, you're competing against investors who can pay in cash. In 2021, at the peak of the pandemic housing boom, investors accounted for nearly 1 in every 4 home purchases in the United States. In some cities, it was closer to 1 in 3. They were outbidding families. They were waiving inspections. They were closing in days instead of weeks. And once they owned the home, they rented it out, which meant fewer homes available for people to buy, which drove up home prices, which made renting the only option for more people. You see the pattern. Now let's talk about what it actually costs to rent versus own, because this is where the numbers start to feel surreal. Let's use Austin, Texas as an example. In 2023, the median rent for a two-bedroom apartment in Austin was about $1,900 a month. That's $22,800 a year. Over 10 years, you'd pay $228,000 in rent. And at the end of that decade, you'd own nothing. No equity, no asset, no wealth. Now let's say you bought a home instead. The median home price in Austin in 2023 was around $450,000. With a 20% down payment, you'd need $90,000 up front. Your mortgage payment, including taxes and insurance, would be around $2,700 a month. That's $800 more per month than renting, which sounds like a bad deal, until you realize that with every payment, you're building equity. After 10 years, you'd have paid about $324,000 total. But you'd own a house worth, conservatively, $550,000. You'd have over $200,000 in equity. The renter has nothing. The homeowner has generational wealth. But here's the cruel irony. That renter probably couldn't get a mortgage in the first place. Because even though they're paying $1,900 a month in rent with no problem, a bank looks at their income and says they can't afford a $2,700 mortgage. It doesn't matter that they've been paying rent reliably for years. It doesn't matter that their rent is already more than some mortgage payments. The system says they're not qualified, so they keep renting, and the gap widens. There's another layer to this. Rent doesn't just take your money, it takes your time. When you're spending 40 or 50% of your income on rent, you can't save, you can't invest, you can't take risks, you can't quit a job. You hate because you need the paycheck to make rent. You can't move to a cheaper city because moving costs money you don't have. Rent creates financial paralysis. And that paralysis compounds over time. Let's say you're 25 years old and you're paying $1,500 a month in rent. Over the next 30 years, you'll pay $540,000 in rent. $500,000 gone. If you'd been able to buy a home at 25, that same $500,000 would have turned into equity, tax deductions, and a paid-off asset by the time you're 55. The difference between those two timelines isn't just money. It's optionality. It's freedom. It's the ability to retire, to help your kids, to weather an emergency without going into debt. Renters don't get that, and the longer you rent, the harder it becomes to escape. Now, some people will say renting has advantages. You're not responsible for repairs. You can move whenever your lease is up. You're not tied to one place. And sure, that's true. But those advantages only matter if renting is affordable. If rent is consuming half your paycheck, you're not mobile. You're stuck. You can't afford to move. You can't afford to save. You can't afford to do anything except keep paying. The flexibility of renting only works when it's cheap, and it's cheap anymore. So why did this happen? How did we get here? Part of it is supply. The United States has been underbuilding housing for decades. Since the financial crisis, new construction hasn't kept pace with population growth. Zoning laws make it nearly impossible to build affordable housing in many cities. NIMBY politics block new developments, and the result is a shortage. When supply is low and demand is high, prices go up. That's basic economics. But the other part is financialization. Housing stopped being seen as a place to live and started being seen as an investment vehicle. When Wall Street figured out it could buy up homes and rent them out for predictable returns, housing became an asset class. And when something becomes an asset class, it gets optimized for profit, not for people. Investors don't care if you can afford rent. They care about yield. They care about quarterly returns. They care about maximizing the value of their portfolio. You're not a tenant. You're a revenue stream. And here's the part that should worry everyone. This isn't slowing down. It's accelerating. In 2022 and 2023, as interest rates rose and the housing market cooled, you'd expect investors to pull back. But they didn't. They kept buying. Because even with higher rates, rental income is still attractive. Even in a downturn, people need a place to live. Housing is recession-proof. It's inflation-proof. It's one of the safest bets in finance. Which means more investors will keep buying. Which means more homes will be turned into rentals. Which means fewer people will be able to buy. Which means more people will be stuck renting. The trap gets bigger. There's a psychological cost to all of this too. Renting in America used to be temporary. It was a phase. Now, for millions of people, it's permanent. And living in a state of permanent impermanence does something to you. You don't paint the walls. You don't invest in furniture that's too heavy to move. You don't build relationships with neighbors because you might be gone in a year. You don't feel like it's your home because it's not. It's someone else's investment. That instability seeps into everything. Your mental health, your relationships, your sense of control over your own life. And the worst part? You're paying for that instability. You're paying top dollar to live in a place you'll never own, in a building you can't control, under rules you didn't write. So where does this end? Honestly, it's hard to say. There are no easy solutions. Building more housing would help, but that takes years and requires political will that doesn't seem to exist. Regulating rent increases could provide relief, but landlords and investors will fight that. Banning corporate ownership of single-family homes sounds appealing, but it's legally complicated and politically unpopular. The truth is, the system is working exactly as it was designed to work. It's just not designed for you. It's designed for people who already own property, for investors who can buy in bulk, for companies that can absorb risk and wait out downturns. If you're a renter, the system doesn't care about you. It cares about extracting value from you. And until that changes, renting in America will keep feeling like a trap. Because it is one. The question isn't whether you can escape. The question is whether the system will ever let you. If this video made you rethink how you see housing or money, consider subscribing. Share it with someone who's tired of throwing rent into a void. And hit the like button if you want more breakdowns like this. Because this conversation isn't over,